The 5 years before you retire aren't just important, they're critical. With the right strategy, you could grow your super significantly, even double it. And in this video, we'll show you how. We'll walk you through 9 key reasons why these final working years matter more than you might think, and how to make the most of them to set yourself up for a confident, comfortable retirement. I'm Chris Trano, Managing Partner of Tyro Wealth and founder of superguy.com.au. We've helped thousands of Australians in their 50s and 60s plan for retirement. If you're new here, hit subscribe so you get all my retirement planning tips. And just a reminder, this video is general information only, not personal advice. You can find the full disclaimer below. So why are the 5 years before retirement so important? Well, this is your best window to grow your super and reduce tax, all while setting yourself up for a more secure, fulfilling retirement. Let's explore 9 compelling reasons why this stage could make or break your retirement. Firstly, peak income, peak savings. For many Australians, the 5 years before retirement represent a financial sweet spot. It's likely you're earning the highest income of your career, having steadily climbed the ranks, and at the same time, your expenses may have eased. The mortgage is close to being paid off, the kids have moved out. With fewer obligations, it's easier to save. Rather than letting the extra income inflate your lifestyle, consider directing surplus funds towards your future. Topping up your super, investing, or paying down your outstanding debts can all significantly improve your retirement position. So if you're starting to wonder, what should I do financially before I retire? The answer starts here. Make the most of your peak income, peak saving years. The financial decisions you make now will be the difference between a great retirement and an okay one. Second, compounding can grow your super rapidly and potentially double it. As you near retirement, your superannuation balance is likely at the highest it's ever been, and here's why that matters. The bigger the balance, the more compounding works in your favor. This first chart illustrates how a super balance of $500,000 could grow to over $700,000 in 5 years at a 7% annual return without any additional contributions. Now imagine you contribute regularly, say just over $4,000 per month. For some people in their 50s and 60s, this is an achievable amount, especially when there's a greater savings capacity. This chart shows how a super balance of $500,000 can double to over $1 million in 5 years at a 7% annual return from compounding and regular contributions. And that's just a starting point. In practice, we help our clients with strategic adjustments, such as minimizing tax, reviewing asset allocation, or optimizing contribution amounts and types to deliver even stronger outcomes. I just want to point out, these projections are for illustrative purposes only. They are not guaranteed and do not constitute personal financial advice. Outcomes will depend on your individual circumstances, contribution level, investment strategy, fees, and market performance. While this is just one example, it helps to show how consistent contributions can significantly grow your balance over time, which leads us perfectly into your next opportunity. It's your final window to maximize super contributions. Your 5 years before retirement are your last best chance to take advantage of super contributions and the generous tax perks that come with them. There are 2 main types of contributions you can make. Firstly, concessional contributions. Concessional before tax contributions include salary sacrifice, super guarantee, and deductible personal contributions. At the time of this video, you can contribute up to $30,000 per financial year. The advantage is that these contributions are taxed at 15% when they enter your super fund, or 30% for high income earners, which is usually much lower than your marginal tax rate. Also, investment earnings inside super are taxed at a maximum of 15% while you're still working. That means you can reduce your taxable income and grow your super more efficiently at the same time. If your total super balance was under $500,000 on the 30th of June 2025, you can also make use of the carry forward unused cap amounts. And this is especially helpful if you've only recently started contributing more. But remember, any unused cap space expires after 5 years. You also want to take advantage of non-concessional contributions. Non-concessional contributions are made from money you've already paid tax on, like personal savings. For the 2025-26 financial year, the non-concessional contribution cap is $120,000. These are not taxed when they enter super, and while you don't benefit from a personal tax deduction for these type of contributions, investment earnings are still taxed at a maximum of 15%. Once you retire and move your super into retirement phase, like an account-based pension, tax on earnings reduces to 0%. Therefore, non-concessional contributions are a powerful way to move money into the tax-free environment for retirement. They're especially useful if you've reached your concessional contribution cap and want to further grow your super. Also, you may be able to use the bring forward rule. This lets you contribute up to $360,000 in one go by bringing forward 2 additional years of the non-concessional contribution cap. I've done a full video on the bring forward rule. The link is in the description below. Think of these caps as use it or lose it opportunities. If you don't act, you could miss a valuable chance to boost your super and reduce tax, especially if you're earning more than ever and have fewer financial commitments. Once you're contributing more, it's time to structure your super strategically. The 5 years before retirement are also an ideal time to get strategic with your super, and one option is starting a transition to retirement pension, or TTR for short. A TTR pension allows you to draw a tax-free income from your super while you're still working. This means you could ease into retirement by working fewer hours and using your TTR pension to top up your income. Continue working full-time while salary sacrificing to boost your super savings, save tax, and use the pension payments to increase your take-home pay. Or delay retirement by working 1 or 2 days a week, preserving your super balance for longer since you're still earning and contributing, while supplementing your income with TTR pension. Additionally, now's the time to consider spouse contributions or contribution splitting. By strategically balancing your super with your partner, you can optimize your tax position, get more into super, and maybe even maximize future age pension eligibility. Now, beyond structure, you still have time to unlock powerful retirement incentives. Are you across all the incentives available to you, or could you be leaving money on the table? The years leading up to retirement are full of valuable incentives, but they're not going to be available forever. So if you're planning to sell your home, for example, the downsizer contribution can be a smart way to boost your retirement income. If you're 55 or over, you may be able to contribute up to $300,000 per person from the sale of your home into super, and it won't count towards any other contribution cap amounts. It's also worth thinking ahead about age pension eligibility. Super, when combined with the age pension, can create a powerful income stream, but your eligibility depends on an asset and income test. Taking the time now to plan for this can help maximize your long-term benefits, even for some people who think they're not eligible. If you're a business owner planning to retire, you may be eligible for small business CGT concessions, such as the Small Business Retirement Exemption or 15-year exemption. These exemptions offer an opportunity to reduce or eliminate capital gains tax when selling business assets. The exemption might also be able to be contributed into super tax-free without counting towards standard cap amounts. Other opportunities may also apply, such as the spouse contribution tax offset and the government co-contributions. Now, incentives are great, but so are smart investments. And that brings us to reason number 6. Your investment choices now can make a difference. In the lead up to your retirement, your investment decisions matter more than ever. It may be wise to gradually rebalance your portfolio and reduce your exposure to market volatility. But that doesn't mean going completely conservative. It's about finding the right mix for your current stage of life. One key reason to review your investments is sequencing risk. That is the risk that a market downturn right before or right after you retire could significantly reduce your savings. A 10% drop now hurts more than it would have 10 years out from retirement. On the flip side, strong returns in these final 5 years can have maximum impact. With a thoughtful rebalancing strategy, you can protect what you've built and give your super a final boost. Once your investment choice is aligned, you'll need to decide when and how you'll access your super. When and how you access your super can shape your income, future lifestyle, and tax outcomes, which is why it's critical to start planning during these final working years. First, understanding these 3 notable ages is essential. Age 60. If you retire or an employment arrangement ends after this age, you can generally access your super tax-free without restriction. Even if you're still working, you should be able to start a TTR pension. A TTR pension gives you access to your super, but at a limit of up to 10% of your balance each year. Age 65. At age 65, you can access your super without restriction, whether you're still working or not. Age 67. At 67, you become eligible for the age pension, depending on your level of income and assets, of course. Second, affordability plays a major role. Even if you feel emotionally ready to retire, you also need to be financially ready. Start thinking now about when and how you'll start drawing a pension, whether you'll keep making extra contributions to super, and when you plan to finally retire. The right decision can impact how long your savings last and how confident you feel stepping into retirement. Another reason these 5 years are so important: You will finally know what retirement will cost. In your 30s or 40s, retirement likely felt like a distant blur. You were juggling a mortgage, raising kids, and switching jobs. It's hard to plan for a future that feels so far away. But by now, in your 50s or 60s, the picture sharpens. The mortgage is nearly paid off, the kids have left home, you know what kind of retirement lifestyle you want, and what it might cost. Have you actually run the numbers on what retirement will cost you, month by month, year by year, or are you still guessing? Start by thinking about everyday expenses and lifestyle goals. These might include travel, healthcare, groceries, utilities, hobbies, entertainment. Once you know what your ideal retirement will cost, you can work backwards. Will your super, investments, and any age pension entitlements cover it all? Your retirement expenses are one of the most important variables. In these final working years, you've got the clarity and time to get it right. And finally, the last reason these 5 years matter so much, reducing debt now can give you more freedom in retirement. The final lead up to retirement is your best shot at a debt-free or nearly debt-free future. Every dollar you no longer owe is a dollar you can use to enjoy life after work. Start by tackling high-interest debts. These include credit cards and personal loans. Clearing them will offer you more breathing room. Next, focus on other non-deductible debt, like your mortgage. Even reducing what's owed can ease pressure and offer peace of mind. Ultimately, retiring with little or no debt puts you in a stronger position. You'll be better prepared for market downturns, unexpected costs, or changes to income in retirement. But more than that, it means less stress, more control, and greater freedom to live on your own terms. As you can see, the 5 years before you retire could make all the difference to the quality of your life in retirement. Even small actions now can lead to big outcomes later. So if you've been asking yourself, what should I do before I retire? Or what are the steps to take before retiring? You're in the right place. In 5 years, you'll either be grateful you acted or wish you had. Start now and you'll thank yourself every year of retirement. Ready to take the next step? At Toro Wealth, we'll help you make these last 5 years count so that you can move confidently into retirement. To speak with one of our retirement advice specialists, book an initial consultation today. Go to torowealth.com.au to find out more. If you enjoyed the video, make sure you like and subscribe.